Hello, today we're going to continue with Chapter 6. We're going to talk about audit objectives. We talked about that a little bit earlier, but we're going to go into it in a little more depth today. Now we're responsible for all of the assertions, not just the top three. We typically audit transactions different than account balances. For the most part, if it's on the income statement, it's a transaction. If it's on the balance sheet, it's a balance. That's not entirely true. We're going to see an exception today. There's the Kpmg planning model that I really like. We audit transactions different than account balances. Here they talk about sales being posted to the sales journal, cash receipts journal. The interesting thing here, so here are significant classes of transactions: sales, cash receipts, acquisition of goods and services, cash disbursements, payroll. But notice allocation and adjustments. That goes in the general journal. Now, most of us learned in 321 that everything goes in the general journal and it's posted to the general ledger. But companies use journals, and most transactions go into a specific journal, and then what's left over, the audit or the adjustments at the end of the year, go into the general journal. Transactions are entered into one and only one journal. We're going to talk about the revenue and collection cycle this quarter. Credit sales are a significant class of transactions. Cash receipts are a significant class of transactions. If we put them together, we have the revenue and collection cycle. What that means is information about two accounts will give us information about the third. So we post from the sales journal to debit accounts receivable, credit sales. So periodically, once a week, once a month, whenever, we post from the sales journal to accounts receivable and sales. Now, notice when we audit transactions, we get information about the sales account, but we also get information about part of accounts receivable. Cash receipts. Similarly, we're going to record the cash receipts, and every Friday or at the end of every month, we're going to post from the cash receipts journal to cash and to accounts receivable. Now, companies are going to treat cash as if it's two accounts. If we have a cash receipts journal and a cash disbursements journal, effectively cash becomes two accounts. They're put together for financial statement presentation, but cash receipts becomes a series of transactions. Fortunately for us, they're fairly easy to audit because the bank statement gives us third-party verification of what the cash receipts were each month. So cash receipts are transactions, but they're fairly easy to audit. So again, we're going to audit cash receipts. That's fairly easy because the bank provides us third-party verification of what cash receipts are. We're going to audit accounts receivable because balances are reasonably easy to audit relative. So if I look at sales, to audit sales, I have to audit all the transactions for the entire period. Okay. It's very difficult to audit January's sales. They're gone. When I audit accounts receivable, I really only need to audit what's left over at the end. Okay. I mean, the balance in accounts receivable is essentially what's left over. So during the period, we have some come in, we get paid, we have some sales, we get paid, we have some sales, we get paid. What's left over is what we need to audit. So if the only cash receipts we received were from sales, be they credit sales or cash sales, now think about that and figure that out for yourself. If the only cash we received were from sales, either cash sales or credit sales, then we could be able to compute with the change in the accounts receivable balance and our cash receipts, we could compute what sales should be. Management assertions for transactions. Occurrence, completeness, accuracy, classification, cutoff, and presentation. So those are the 6 assertions that relate to transactions. We're going to use those assertions to create audit objectives for sales. Now, here's what the book shows for our audit objectives. Occurrence, recorded sales are for shipments to non-fictitious customers. Shipments to real customers. Completeness, all sales that occurred are recorded. Accuracy, recorded sales are for the correct quantity shipped and the correct price billed. Quantity and price. Classification, sales or transactions are properly classified. So if we sell inventory, it's a sale. If we sell a fixed asset, then that goes into gain or loss down in the other part of the income statement. Cutoff, sales are recorded in the correct period. Presentation, sales revenues properly aggregated. Remember net sales, sales minus sales returns minus sales discounts. Now this section of the book is really, really good, and I want you to read it because very closely. The transactions are general. So the assertions for transactions are general and relate to all transactions. We need to make them more specific when we're auditing a specific account. So if we're auditing sales, then sales in the sales journal are for shipments that actually occurred to non-fictitious customers. So the general assertion is that all transactions recorded in the income statement actually occurred. Well, what's that mean for a sale? What's it take for a sale to occur? Well, the customer ordered it, we shipped the goods, we billed the customer. So we need evidence that this sale was actually a shipment to a real customer. Completeness, again, we're going to have to read the general, which is assertion for transactions, and we're going to have to tailor that to sales, that all sales that actually occurred got recorded. So I want you to read and study these 6 paragraphs as they relate to occurrence, completeness, accuracy, classification, cutoff, and presentation. Notice I'm skipping posting and summarization. We're only going to cover those that directly relate to assertions. Cutoff, the book calls it timing. We're going to call it cutoff. We don't need to learn more words. So study those 6 paragraphs quite a bit. If audit objectives are based off of the assertions, then for each significant class of transaction and every significant class of transaction, we must obtain sufficient appropriate evidence to support each and every assertion. So if the assertions become our objectives, then we need evidence to support those assertions. There's 6 of them for each and every account. So if I've got 5 significant classes of transactions and there's 6 assertions, that means I have to gather evidence to support 30 objectives. 5 times 6. Here they are again. So we go from occurrence, that all transactions on the income statement actually occurred, to recorded sales are for shipments made to non-fictitious customers. It becomes more specific. Then we've got the balances: existence, completeness, accuracy, valuation, and allocation, classification, rights and obligations, and presentation. You want to read here very closely for these 6 paragraphs again. Now notice we've got existence, and we're going to take existence. The assertion is general for all balances, and we need to tweak that, if you will, and make it more specific if we're auditing accounts receivable or inventory. We need to make it specific for the account we're auditing. Completeness, accuracy, valuation, and allocation. Now the book separates accuracy, but we're going to just do what we have for the assertions. So since there's an assertion for accuracy, valuation, and allocation, that's the way we're going to think of it. Cutoff, well, that's transactions. So we're not going to worry about cutoff for balance sheet accounts. We're going to worry about it for transactions. Detailed tie-in, we're not going to worry about that because that doesn't relate directly to one of the assertions. We're just going to deal with the 6 assertions. Now notice 3 pops up again. And what it is here now is, now to us, it's accuracy, valuation, and allocation. It's realizable value. And this is really an example of valuation. We report accounts receivable on the books at net realizable value. So if net realizable value is less than the face value of the accounts receivable, then we're going to make an adjustment. Remember, we record accounts receivable less allowance for doubtful accounts, and that's called net realizable value. That's a valuation account. Similarly, we record inventory at the lower of cost or net realizable value. So that's a valuation. If we use FIFO, we report inventory at the lower of cost or market. That's another valuation. Classification, rights and obligation, presentation. So study those 6 paragraphs and know them well. I think the book does a really good job of describing those. We're going to use the assertions to create audit objectives for inventory or accounts receivable. Inventory is easier for me to think about. Existence, all recorded inventory exists at the balance sheet date. So all recorded inventory actually exists. Completeness, all existing inventory has been accounted and included in the inventory account. Accuracy, valuation, allocation. Inventory quantities on the client's perpetual records agree with the items counted on the physical inventory. Cost used to value inventory are correct. The extension of cost times quantity is correct. Down here, there's the realizable value. And that's because inventory is recorded at lower of cost or net realizable value, if net realizable value is less. Now we've got classification. We've got raw materials, work in process, finished goods, rights and obligations. Does the company actually have the rights to that inventory? The fact that a car's sitting on Miller Motor Company's lot doesn't mean Miller Motor Company owns it or has the right to sell it. Again, if audit objectives are based on management assertions, then for each significant account balance, we must obtain appropriate evidence, sufficient appropriate evidence to support that objective. So if there's 7 significant account balances, there's 6 assertions, then we'd have to satisfy 42 objectives. We'd have 42 different audit objectives, and we need evidence to satisfy all 42 objectives. Way back on page 557, there's a table in the book that shows the audit objectives for accounts receivable, which is what we're going to deal with. Number 1, accounts receivable and the aged trial balance exist. Somebody actually owes us that money. 2, existing accounts receivable. All existing accounts receivable are included in the trial balance. I'd hope so. Accounts receivable and the trial balance are accurate. We're going to call that accuracy, valuation, and allocation. Accounts receivable are presented at net realizable value. That's your valuation account, right? So we report accounts receivable less allowance for doubtful accounts. 4, accounts receivable are correctly classified. We report trade receivables from customers different than we report receivables from directors or officers of the company. We report short-term receivables different than non-current or long-term receivables. 5, rights and obligations. The client actually has the rights to those receivables they report on their balance sheet. And last, accounts receivable are appropriately aggregated and disclosures are correct. Thank you, and there is another presentation related to the audit risk model.